Hello, everyone, and welcome to the webinar, Impacts of the U.S. Inflation Reduction Act on SEEIT. My name is Lolita Jackson, and I'm Executive Director of Sustainable Cities for Sustainable Development Capital, LLP. I joined SDCL in April 2021 in that role, and I was, prior to SDCL, the New York City climate diplomat, where I dealt with governments around the world in obtaining their climate action goals as well. You will hear from several speakers today. If you have any questions during the presentations, you can submit them through the webcast page using Ask a Question button, excuse me. Our first speaker is Jonathan Maxwell, CEO and founder of SDCL.
Thank you, Lolita. Thank you, everybody, for joining. We wanted to talk about the Inflation Reduction Act today because over 60% of SEEIT's portfolios in the United States. And the Inflation Reduction Act makes a difference to how we think about investing in the US and potentially provides significant benefits. Now, in the past, SEEIT's been investing in established on-site generation and energy efficiency projects in the US because it helped clients cut costs and emissions and improve energy security. And today, SEEIT's portfolio has an additional dimension of opportunity because of the Inflation Reduction Act. The Inflation Reduction Act, and Thomas will take us through the details, started life actually as a $1.7 trillion bill, the Build Back Better bill. Eventually, it was passed after the social programs were excluded. But still, the program is worth, economists estimate, between $369 billion to even up to $1 trillion. So what's it about? So we estimate that about 80% of the stimulus, if you like, or market incentive provided by the Inflation Reduction Act will provide financial benefits to reasonably mainstream conventional clean energy solutions such as wind and solar. But about 20% of it, which is an incredible amount of money, is likely to benefit energy efficiency, broadly defined, in the form of decentralized and on-site energy, but also energy conservation projects. Just to be a bit more detailed, there are specific tax credits and deductions, which are the main instruments through which the Inflation Reduction Act operates. This will provide quite a substantial benefit to buildings and industries, and it's supportive of new projects which are expected to accelerate now because they're more attractive thanks to these credits and benefits of the Inflation Reduction Act. So without wanting to open up with all the detail, just to give an example about how that works, this is a very specific menu of incentives that the US government has introduced. It's a highly directed market incentive program, and it affects energy efficiency in a positive way. On the demand side of energy, on energy conservation, two of the provisions that are important, for example, are something called the Energy Efficient Commercial Buildings Deduction and the Business Energy Investment Tax Credit. The way that this works is deductions apply to quite a wide range of technologies: lighting, heating, ventilation, hot water systems, installation of interventions across the demand side, and for example, provide specific amounts of capital per square foot for deductions for improvements. So, for example, you get about $5 a square foot as a deduction for energy efficiency improvements of 25% or more. So that's how the deductions work. Separately, there are tax credits, many of which are actually tradable, which provide up to 30% of the upfront cost of qualifying energy projects. And good examples of qualifying energy projects that are relevant to the sort of decentralized solutions we invest in are things like wind, on-site solar, and battery storage, mostly on-site solar and battery storage, obviously relevant to our programs, as Buck will pick up later. So there's plenty in the Inflation Reduction Act to address other innovative technologies, carbon capture, green hydrogen. But SEEIT's investment style has always had a very strong affinity to proven technologies. And the Act, we're very pleased, provides a lot of attractive incentives to make those work better and at larger scale. We've got two guest speakers on today, Thomas and Buck, who Lolita will introduce, and they'll report from the ground for us that is from the United States, on the tailwinds that have been introduced by the Act and how we as SEEIT can benefit from it. Lolita, back to you.
Thank you, Jonathan. Now we will hear from Thomas Rosen, Managing Director and Head of Investment Banking for Low Carbon Transition Group, North America for BNP Paribas, who will provide an overview of the effects of the Inflation Reduction Act on the technologies and markets. A reminder to please submit your questions for Thomas through the Ask a Question function on the webcast page, and he will answer at the end of his presentation. Thomas, over to you.
Great. Thank you, everyone. Good afternoon for those in Europe. Good morning for those of us in the US. It's certainly morning. Pleased to be here. A little context on who I am and what I do, right? So what does investment banking mean? I'm the M&A guy. So the strategic dialogue person, the one talking to investors, the one talking to sellers, sitting in between and watching the market and understanding the market's views. Before I start, the internal team here has asked me to make sure that I say that the views expressed today are my own, so you understand that. I've been with BNP for about 8 years. As you can tell by looking at me, I've been in the industry a long time, always focused on this space from early days all the way through. SDCL and SEEIT have been clients, one of our favorite clients. And we actually advised Blackstone on the sale of Onyx to SEEIT, and that was a great transaction for everybody. And give you a sense when I go through the presentation today of what I speak from. We're very active in this space. I have something like the team in the U.S. alone, it's been like 5 active transactions in the market. We've done 11 active transactions in the last just under 2 years, and that doesn't include the financings, the joint ventures, and other things we've done. And then, as Lady said, I'm happy to take questions at the end of the presentation. So let's start. Let's go to page 3, please. Who's ever moving the dialogue or the presentation forward? It'll say executive summary on the top. Thank you. So first, I want to give a bit of an overview on this space. I'm going to cover the space a bit, IRA some, and then really conclusions. That's really what I want to bring you to. So on the IRA, Jonathan, I think, really did a good job of talking about how it affects SEEIT and its U.S. businesses. I'm going to give sort of the implications of the IRA and not get into the details. In fact, if you focus too much on the details of how it works, you're going to get a headache. It certainly gives me a headache. The key is, what does it mean for growth and valuation and market activity? That's the real key. They're professionals who spend their time focused on this, and that's what we leave them to. What I do is think about the implications of it and what it means. But in short, it's a game changer. It truly is. It's across the board. It'll spur growth. It'll spur development, and it'll do so for the foreseeable future. It's so impactful that we understand other geographies are actually thinking about what kind of incentives they'll need to put in place to remain competitive with the U.S. And you'll see some slides later that I think really show the potential growth. And the bill is broad. The second point there, we focus on storage and other solar and storage because those are 2 of the bigger beneficiaries of it. And in fact, distributed solar, as Jonathan was talking about, we think will be one of the, for sure, biggest beneficiaries of it. I'll make some comments on that. But it's across many technologies, including hydrogen and other technologies that will be strong beneficiaries of it, including on the usage side. And in particular, as you'll hear as a theme through here, DG solar we think will be a very big beneficiary of it, particularly as you think about how it gets rolled out. So it's distributed. It can be put where it needs to be put. It's going to solve problems more closely to where the problems exist. And a theme you'll hear me say throughout, it's also where we find investors are most interested in investing at the moment, is into that space and its effect on the grid. To be clear, other technologies will benefit as well. 2 of the big ones we see are carbon capture and hydrogen, but those are completely different markets. Those are billion-dollar investments, and they're all building something that are big and of scale. So with the IRA as a backdrop, as we think about, if you sort of look at sort of 3, 4, and 5, I'll talk to them all together in the way of presenting. We believe one of the best uses of capital that we see in the market right now, given where the M&A market is, which is a little bit flat, you'll see some statistics on that, is increased and continued CapEx into platforms. So putting money into the platforms, growing the platforms, availing yourself of the IRA bill itself and other forms of capital, and growing the platform, and then That'll be manifested later into the M&A market, where we'll see trades start to happen and value. So putting money into a platform, growing the platform, Onyx would be a key component of that. For instance, putting money into Onyx and growing it and later selling it. 4 and 5, a couple just points on the market. There's no shortage of interest from buyers, even with market activity down a little bit. The key is, I make these broad statements, but you have to sort of take it to the next level. So yes, there are some values where there are some instances where values are down. Certainly publicly traded entities have come down in price. There's more to that, though. Where we've seen strong components of value and activity is where there's a unique development strategy or some sort of a differentiator or technology. So if it's a strong developer with a strong background and a strong history, they continue to get very strong values. If it's a technology that's in favor, distributed solar, for instance, very much in favor, continues to get strong value. And we see that as an underlying differentiator in the market and really where we see things continue to move forward. With that, I think we can go to page 4. So on the IRA market itself, so I think you probably generally understand how it actually works. It provides a tax credit for either production or investment that then offsets your income if you theoretically, or if you have income. The truth is most people who are providing the credits or doing the development to get it don't have the income to offset. So there's this transaction market that's developed generally with financials that have that buy the credit and then provide the funding back to the entity, because in reality no one can really use it, and so that's been interesting, and it's a big part of what's happened. The bill, though, sort of transforms that. What are some of the key takeaways? Well, first, the size and length are tremendously expanded. So in terms of the length, think of this just as 10 years. Well, why is that important? For those of you who have followed history of the U.S., there's been periods where in December, when the tax credits were going to expire, no bill was passed. It gets into the new government into the next year, January, February, one is passed and there's a catch-up. So there's this roller coaster ride. And so people are asking, am I going to continue to see these credits, and how will this work? That removes that. It also expands it both in the size, and you'll see we've highlighted down on the bottom some of the adders, if you will. One of the bigger ones being energy communities, which many people are trying to avail themselves of. And it's also expanded it to other technologies. So I've mentioned storage a few times. Battery storage did not qualify before. It does now. Hydrogen, depending on how you think about it, there were some grants, but now definitively qualifies for credits. Those are all game changers in terms of the market. We see that continue to go. So what's the takeaway? It provides a continued source of funding. It enhances returns. It will codify and focus on differentiated strategies and companies who will be beneficiaries of this and be able to utilize it better and continue to grow. And you'll see more growth and increased value in the U.S. Go to page 5. Thank you. So I like this chart. A bit busy. I stole it, to be clear, or the contents of it. On the left-hand side in the bar chart, what you see are by color the biggest issues for emissions in the U.S. Obviously, power and industry are big ones. The ovals on each side of it indicate the size in the particular from the two bills where they're focused. And so on the left-hand side, obviously, power is a big issue. That's where the bill is focused, is solving power. And think of that as then, for instance, spurring more solar development, for instance, DG solar. So it's focused correctly. This is, for once, we've got this correct. This is a good bill, focused correctly with lots of good things to it. Right-hand side, general implications by color. Colors are tough for me, but if you look at the yellow, which I think is the biggest, is generally showing you solar, in particular residential solar, distributed solar will be huge beneficiaries of it. And you can see the steep growth, but just take away the curve, the size of the curve. It's just a tremendous pickup in value. And in fact, if you go to the next page, page 6, This is a page we use a lot. So focus on the right. Up the top half is solar. It's hard to break out utility scale from DG, so it's lumped in together. We are focused on both, but think DG in the back of your mind as you're looking at this. The two colored charts, the two colored bars show the solar forecasted build out before and after the IRA. Just look at the tremendous increase you see specifically going forward into the future. This is driven by the IRA bill, the ability to avail yourself of the ITC. Solar can also get PTC, the community credits, the credits where if the solar panel you're buying are built in the US, just tremendous benefit in terms of scale. Down below, we've picked on storage. Part of the reason we've done that is because it's now qualifies, and we're seeing solar plus storage co-location, a continuing theme even for distributed generation. These are big numbers. The growth before was good. I would point out even these need to increase more to hit the current, at least under the Biden forecast of rules, are net zero numbers. But this is highly encouraging in terms of the build out. And then even more interesting, I think, is if you go to page 7 and you look at it by region. And this is important because this is regionally, this is where we're seeing interest. So you know the regions. ERCOT is Texas, standalone Texas is like its own country in the US. MISO, which is the Midwest, PJM, which you're all familiar with, I'm sure, and then California. As we talk to the market, where we see some of the strongest interest is in, for instance, in MISO, given there's congestion constraints and other things. Now, and I'm picking on storage and solar plus storage here because I can get the data, but this would be true for everything, including distributed solar. Look at the bottom. Just that we did storage and solar plus storage again because the data is easy. The tremendous uptick in terms of the growth pre and post. Why is it interesting? MISO was a burgeoning market. It's always been an interesting market, but it doesn't function quite the same as the other markets, but it's of strong interest. With the IRA, game changer. So investment that should go to MISO, needed to go to MISO, is really there now, and we're seeing that kind of growth. So I think this is just very interesting to see in action what the IRA bill will do to the U.S. and to growth and to value. So we can go to page 8. So I'm gonna spend a little more time on this. So in the top bar, a little bit about the market. I'm thinking transactionally now. So think of this more as a transactional slide, an M&A slide. So it's a bit of a crowded market. There are a lot of transactions in this space, but as I alluded to before, you've got to drill into it. And what we're finding is that values are down, and I'll talk about that in the second bar. But as you drill into it, you'll find platforms that have a strong background, a strong history, operating assets, the ability to commercialize them, and a real platform, a real pipeline, garner strong value in this market. And those assets or platforms or developers that have preferred technologies, DG Solar being one, to be clear, there's others, but DG Solar being one, continue to be strongly in favor. In fact, as we talk to investors and we quiz them, and I spend almost all of my time talking to investors or sellers. I don't think of myself as necessarily doing deals. I think of myself as understanding the market and bringing it together. Investors want certain technologies. DG Solar is one of those. But it's clear in the second bucket there, the second box, higher interest rates have manifested themselves as higher returns across the board. I focus on my day job, but my other job is looking at the whole of the U.S. For the last 2 years, I've been chairman of the investment committee, the mandate committee in the U.S., which meant I set fees for all of the M&A teams for all the U.S. across all strategies. And so I saw where things were going, and required returns because of interest rates have come up. However, there are some tailwinds that are truly offsetting in our space. I didn't put the slide in, but PPA prices are coming up, offsetting it. We're seeing market growth come up, offsets it. Clearly, the IRA offsets it, and moderating inflation. We'll see where that goes. But in my view, a moderating inflation continues to help on those valuations. In the third bucket, So a little more of what's going on in the market from an M&A perspective. Volume's down, but supply is up. So what's happening? It's really kind of a misalignment of value given more people trying to bring assets to market in an environment where interest rates have gone up, where inflation was there, but now coming back, and there's a stasis that has to come back into play that we think will happen in next year. But even with that, we're seeing differentiated platforms continue to trade at the same strong values we saw last year, which was a different, better market for sellers. So we see the future looking quite bright, if you will. And you see continued investment in the U.S. from offshore players. Repsol, a big Spanish renewable energy player, has just done its second large transaction in the U.S. by buying ConnectGen, a big, well-known, strong, good U.S. platform. Other issues, obviously, the public market not been great. IPO market starting to maybe come back. But we sort of see that as a trend, right? Where the IPO market tends to fall off, the public market falls off. But as people continue to see the private market print and differentiate and sort of show where the future is, we see that starting to come back up. And we see this, this sort of, if you will, optimism you see in the next year. We see that going for a while, driven by the IRA bill. And as I mentioned, what we see people doing now, which we think is a winning strategy, is continued CapEx into a platform to grow it, to get it to a point of good, solid growth in the next year, and then think about what people want to do from there, whether it's a JV, a sale, more CapEx, a monetization of some sort. We go to page 9. So this is a little bit more on the M&A market. Again, and it shows you that you have to look into it a little bit harder. On the top is just the market, and you'll see from 2023 to 2022 by transaction volume, it's down. Now, the general market, by the way, in 22 and 23 is down much more. So compared to all of the industries, we're doing much better. But if you look at solar, again, this is all of solar because it's not so easy to pull DG out of utility scale solar. It's up. And so that's an indication of where people are differentiating, where the bill is calling out winners, and where people should be thinking about putting their money. And again, to be fair, there's other strategies of which that's true, but those in our mind are completely different strategies for completely different types of investors. And we're seeing, particularly in the C&I space, recent activity. There, can turn to my side, and I have a list of some of the recent C&I deals right here that are quite encouraging to us. On page 10, it's a busy page, so this is one of those sort of pages, just kind of a takeaway. So it's 2021, 22, 23 announced deals, some of which have closed. Obviously, if you're someone who follows it closely, you'll point out that Duke and Duke are both done. Broadreach is actually now closed, and so we could say announced and closed. And then ongoing is on the right, where in various forms, some are coming and going from the market, but these are ones we know of and have been announced, and our deals on the market, just giving you a sense of activity. This has both good qualities to it and bad qualities to it. I said there's a lot going on in the market, but some of these are assets that are highly differentiated and are highly likely to trade at strong values. And if we go to page 11, this just tells you more specifically some of the assets that are on the market. And I've tried to make sure there's solar in every piece of it, or storage. So this isn't specific to, for instance, C&I or I should say DG, but just generally in the market. Again, a tremendous amount of activity. And then finally, some comments about DG Solar. I apologize, might be some background noise. I'm at home today. A big growing segment. As I said, this is a segment that's in favor. Sorry, hopefully this will be better. In favor in the market, and again, where investors really want to put it. And I think the question is why? Because it is distributed, which is, we believe, and the market believes, a winning strategy going forward. Has tremendous growth because the market is still nascent for it. Everyone is thinking big utility scale solar. Well, that's great. It's risky. It's not easy to do. It's not easy to site. Distributed solar is where we believe the market is going, and we'll see more of that. And then adding adders to it, such as solar plus storage, which we're seeing as one that's not, maybe it's on here, maybe we took it off, adding EV charging to distributed solar, an interesting thing we see happening. Obviously, community solar, a big piece of it, and then the market, the MUSH market as we define it, just a really big market that continues to be an addressable market. That's my prepared remarks for today. I'm happy to take questions. I think the way we're doing it is someone will say the question out loud and I'll answer it. Is that correct? I'm not able to actually run the question component of this.
I think there's a question that came in specifically, I think, what impact is the Inflation Reduction Act having on existing operational renewable or energy efficiency infrastructure assets? Thomas, I'd have a comment about that. Poppy may also, but do you want to have a first go at that question?
Well, if it's already operating, it doesn't itself, like to qualify, like once it's sold and operating, you don't re-qualify for it. But what it's doing is, for instance, operating assets that can be refurbished and quote repowered, which is a definition. And if it's repowered, it can produce more tax credits. So we're seeing people actually put more money into things and continue to grow it. But it does have a side effect, because people who are buying operational assets tend to do it and think about growth going forward in an associated pipeline. It's actually going to increase the value of those assets in our mind. Go ahead, Jonathan.
Yeah, I mean, I was going to make that point actually, which is that, I mean, specifically, giving examples in our portfolio, we have, and Buck will talk about it in a second, but an investment in our portfolio, Onyx, which is consists of projects under operations, but also under development and construction. Clearly, the development assets will benefit from the Inflation Reduction Act, but also so too, as you say, with the value of the company that we own, which is developing those assets, and of course the incremental value associated with the projects in the pipeline that will benefit from this market incentive and therefore add value to the projects. We would expect to be a very good story, Thomas, for Onyx, and we have platforms like, for example, Red Rochester in upstate New York, where we're consistently making new investments, which will be a number of which will be specifically benefiting from the Inflation Reduction Act.
One of the best things a current platform can do is continue to put CapEx into it, avail themselves of the tax credits, and grow in a market that wants the particular set of assets. So I don't know if I give this anecdote, but last year we were taking an asset to market. The IRA bill hit in the middle of it. We paused for 2 weeks. The value went up. We got a much higher price. It is increasing values in the asset, and DG Solar will be a strong proponent of it. So, and at the risk of being obvious, the value of Onyx going forward should be enhanced given the IRA bill. Other forces as well, as I mentioned, but clearly that's a proponent and a strong underlying value enhancer for assets like Onyx.
I don't think there's any other questions we've had on the feed. I wonder if it's worth taking a second for any further questions live, but otherwise, Lolita, perhaps we move on to the next section.
Yes. So
Okay.
if you have questions
Thank
later,
you.
Thank you, Thomas. If you have
Thank you.
questions later,
I'll be dropping now. Thank you, everyone. I need to drop. Thank you, and it's been a pleasure.
If you have any questions, again, please submit them through the Ask a Question function on the software platform. Now we'll turn to Purvi Sapri, Fund Manager of SEEIT, and Buck Fletcher, Chief Financial Officer of Onyx Renewable Partners, to discuss how the Act can positively impact the SEEIT portfolio. So once again, you can submit the questions for them and they will answer after their presentation. Over to you, Purvi and Buck.
Thanks, Lolita. So for those of you who don't know me, I'm the Fund Manager for SEEIT. And I'm responsible for looking after the investments across the fund. It was great to hear Thomas talking about the benefits of the IRA and particularly how it applies to assets across the region. What's great about this legislation is that it's a great tailwind for SEEIT. Over 60% of SEEIT's investments are based in the US, the majority of which are going to benefit from this policy tailwind. And there are a number of upside benefits that the Inflation Reduction Act can generate for the projects. Now, Jonathan's provided an overview of the direct ways in which it can provide financial incentives for energy efficiency and distributed energy. Tax credits, which can be traded for flexibility, as well as deductions, can boost financial returns. But if I focus specifically on SEEIT, and Thomas made a good point, which is there are benefits for existing operational assets. And as you'll recall, the majority of SEEIT's investments are on the operational stage. But there are ways in which those assets themselves can also benefit from various aspects of the Inflation Reduction Act. And I'll use, Jonathan mentioned the Red Rochester investment, which is a district energy business in upstate New York. Now, whilst that's operational, there is investment that's being made on various technologies, combined heat and power, and waste heat, all of which benefit from production tax credits from the Inflation Reduction Act. And that's a way in which we are making investments at enhanced returns. Talking about waste heat, Primary Energy, which is our investment of assets that is taking waste heat from steel mills and recycling that to produce heat. Now, the existing assets are operational, but using the technology, we can then expand our presence across not just existing steel mills, but across other steel mills across North America, utilizing the same technology and benefiting from the production tax credits. We've got investments in Spark Fund and Future Energy Solutions, which are improving the efficiency of buildings across the US. Again, Jonathan and Thomas both alluded to there being enhanced benefits around the Inflation Reduction Act, which will help boost the deployment of capital in those sectors. And finally, we've mentioned quite a few times Onyx, which is our investment in commercial and industrial on-site solar across the US. We originally made the investment into Onyx Renewable Partners to acquire a portfolio of operational assets. This is Onyx Renewable Partners, which is a platform that we acquired before the Inflation Reduction Act was enacted. Along with a portfolio of operational assets, we also acquired assets under construction and the near-term development pipeline from Blackstone, and owned 50% of this development platform alongside Blackstone. Earlier this year, we acquired Blackstone's stake with the objective of driving value and achieving capital gains, as well as income from our investment in Onyx and its projects. And as we've answered in the previous question, having that pipeline means that we're able to secure the benefits from the Inflation Reduction Act. I'm going to pass on to Buck Fletcher, who can talk about the experiences of Onyx on the ground. Buck serves as the CFO of Onyx Renewable Partners, where he's responsible for the firm's M&A and capital markets activities. He spent the bulk of his career in various areas of energy finance and is working with his team to utilize aspects of the Inflation Reduction Act to accelerate Onyx's growth. So over to you, Buck.
Thanks very much for the kind remarks, Purvi. Good morning and good afternoon. Thanks for having me, and it's a pleasure to be here. So we at Onyx are developing clean energy solutions for our clients on the distributed side, and we've been in the distributed space since 2014. Most of our projects sit behind the meter, which, as we like to say, means that they're interconnected, smaller distribution lines, and are associated with retail customers. So take this into contrast to large utility scale projects, the big ones that you'll see on the desert, that are in front of the meter and interconnect with larger transmission lines and often sell into wholesale markets. Our projects typically range from 500 kilowatts to 3 megawatts, and our customers are townships, municipalities, larger government entities, and commercial and industrials, both large and small. We're a fully integrated developer, and by that, I mean we house developers, construction managers, finance professionals, and asset managers. We stay with our projects often from inception all the way into continuous operation. So we really are a one-stop shop for a solution for anyone that's interested in adopting distributed energy. We develop our projects both directly to our customers and also through smaller development channel partners. But we build, we finance, we own, and we operate. We're just over 50 professionals, and our firm's headquartered in New York City. So to talk for a moment about the DG market itself, we expect it'll add roughly 2 to 2.5, probably closer to 2 gigawatts in the U.S. this year, which is about flat from the 2 gigawatts added last year. We expect further growth upticks these next few years as developers now have the option to sell tax credits, as Thomas pointed out, rather than having to go and raise tax equity. So we're also taking that and coupling it with declining module prices, and that's going to further fuel installations. We expect demand from corporations that have sustainability goals to continue to increase. Anyone paying attention to the public markets are hearing the words ESG and have been for the last 2 or 3 years. And we certainly believe that our product can be a cornerstone of many of those initiatives, especially those that have a large geographic footprint. Thomas did say it earlier that higher interest rates have persisted. And, when we combine that with construction costs that have gone up and developer markets that are squeezed, it's putting a little bit of pressure in the near term on long-term equity holders. We're not expecting equity returns and underwriting to go up as much as the risk-free rate has in the midterm. And that's really thanks to the tough competition from project acquisition and from competitive RFPs that we'll often participate in. So at this point, it perhaps goes without saying that the IRA is a very welcome tailwind that in many cases is, for us at least, more than offsetting these headwinds. So how is the IRA interplaying with the DG space? Net, it's very positive for the space. You heard it in Thomas's presentation, and we're certainly living it here at Onyx. It grants an element of certainty for a known period of time, and that allows us to plan better in the longer term. Number two, it enables projects that would take longer to become economical by offering a credit today and therefore lowering that cost and making the price go down so that it's more enticing to the customer to do the project. And then three, the carve-outs for low income and energy communities speak very specifically to the DG market. When you think of urban areas that qualify for that, it's really hard naturally to go in and put a utility scale or any kind of large power source without a lot of disruption to the infrastructure. And so our product, we certainly believe, is a mitigant for that. And we certainly see the IRA speaking to this very aspect. So just in the past decade, we've lived with multiple tax credit cliffs. And when you have a cliff, it's almost always going to halt the development of a project unless you can get that project placed into service before that cliff comes. So if we know that there's going to be a step down from a tax credit that's at 22%, and then next year it'll become 10, you better get that project placed into service so that you can get the 22% tax credit, because what often happens is your financing mechanism is going to have an adjustment so that they can still monetize the lower tax credit to get that return. So if you end up in that situation, it's going to come back and hurt your economics as the developer owner. So by having these cliffs that have been existing prior to the passing of the IRA, it's really put a lot of pressure on developers to get things done. And oftentimes when you're looking at a construction timeline that is just going to be too close to a cliff for a tax credit, sometimes you just don't do the project. You wait around. You say, let's wait and see what happens. It's either a no or it's a delay, and so that's obviously very disruptive. And on the margin, has halted or stopped a lot of projects from going forward. So this is going to allow us a lot more time and certainty going into the future when you're looking down the barrel at 30% tax credit, base tax credit for our projects by and large, and that's going to allow us to go and plan longer term capital, whether it's going in and financing inventory that we're then going to put into those projects, which we never would have done in the past, at least to the extent we are now, not knowing what kind of credit we're going to get on our project return. So giving that certainty is really helpful from a capital planning perspective. It's also worth mentioning that the traditional way of monetizing tax credits over the last decade or so has been through tax equity. At a high level, you can think of tax equity as senior debt-like investment that receives a cash yield over a period of time, and most importantly, that monetizes the tax attributes of a renewable energy project, namely the ITC. To simply characterize the tax credit, you can think of it as you would if you're financing a house. If your house costs $100 and on day one, the government gives you a tax credit of $30, and if you monetize it, your cost basis is now $70. So that's a really meaningful subsidy when it comes to cost reduction. What the bill also introduces is the transferability of the tax credit. So we didn't have this before, which meant that if we're not a tax efficient entity, which we're not, it meant going to banks or those that had tax capacity to monetize that tax credit. So they would invest in the project alongside Onyx and then monetize that tax credit, and we would retain most of the cash attributes of the project. They would take some of them, which is part of their return built in tax equity, and that's typically how most developer sponsors would operate. Now, with the passing of this act, financial institutions are no longer the only show in town when it comes to financing renewable energy assets. So the market is just now developing, and we certainly see 2024 as a formative year and a transitional year. We combine that with Basel III, which doesn't really it's exclusive from the IRA, but it's putting more constraints on bank balance sheets, and it's making the IRA or the transferability aspect of the tax credit therein so much more important, because if it means that banks are going to be more constrained and more sidelined than before, it'll be important that non-traditional investors in tax credits, tax equity, come into the market, and they are. Indications in the DG market are suggesting anywhere from 88 to 92% on the credit. So, if you're using a 90% number, you can think of that as a 27% tax credit at the end of the day if you otherwise were going to get 30. So in terms of IRR accretive opportunities, we're seeing more of these in the near term, just simply because projects that were underwritten prior to the passing of the IRA are now receiving a boost that we otherwise hadn't contemplated. We assumed we were going to get 22% on the tax credit, and all of a sudden now we've got 30% plus a potential adder for low income or for an energy community. And that's obviously a windfall, and that's going to be great for the near term portfolio, as about 20% of our portfolio that we'll do this year will have benefited from one of these adders. 100% of our projects going forward will benefit from the IRA, not necessarily from the adders, but from the IRA, and that we're expecting to capture at least a 30% ITC for all of our projects. And as I just handed, a subset of those will contain additional adders if they qualify for some of the carve-outs. So let's take a look at what would have happened had the ITC dropped to 10%. Projects previously underwritten at higher ITC amounts, that would have had to have placed them, into service by the time it dropped to 10%, it all would have stalled. At temporarily higher prices brought about by the supply chain crunch, this would have constrained returns, moved PPA prices higher, stunted demand. With the result of the latter, if you got a higher PPA price, it's going to be less enticing for an off-taker, one of our customers, to want to sign it. So they're going to wait till pricing changes, or they simply won't do the project. With a 30% ITC, and we do have to couple that with a 10 to 20% addition in construction costs, because the IRA does come with wage requirements as well, and that's obviously great for job growth and creating sustainability in the industry. We're seeing on average about 150 basis points of net improvement using just plain market assumptions. When you use the adders for energy communities' domestic content, we see up to 700 basis points of net improvement on an unlevered basis. So this is really quite meaningful if we were simply to isolate the return, holding all else constant. Of course, in reality, we're going to see the invisible hand of the market meeting this upside with a reduction in the PPA price, or the price at which they're willing to offer the customer. So if we were to look at this from the standpoint of a discount to PPA pricing levels in isolation, as opposed to the return, moving the basis points up and down, we're seeing pricing come down a further 15 to 20% on electricity prices, holding a return constant. So when you're playing with those two variables, the answer is going to get you, someone's benefiting. It'll be either the off-taker or the investor, or both. But what will also result in is a greater availability of projects, because it now makes projects that weren't economical because the offer pricing was too high, now in the money for customers to go and want to get it. So we should expect a lot of the benefit to come from the growth, in my opinion, And the natural question on this panel is, how has this affected Onyx? What are we seeing from just the initial guidance that's been provided to the IRA? Well, what we can say is that we are getting a temporary uplift in projects that were underwritten using different assumptions. I alluded to that already. Our pipeline has grown from an average 500 to 600 megawatts going back a couple of years, and we're now at well over a gigawatt and growing. So we are seeing volumes really come, and I think that the IRA, with elements that we described here today, have certainly given rise to that volume increase that we're going to see manifest itself in built projects over the next 2 to 3 years. The last thing I want to add is that it's creating a considerable amount of jobs in the country, and that's going to help depoliticize renewables as an asset class. A lot of the manufacturing is moving into red states and purple states, and we certainly expect it to not be a Republican versus Democrat issue, or much less so going forward. So I think that the message for Onyx and for all of our fellow market participants is that we need to continue investing at a high velocity and help the industry mature, and that will be a cycle of sustainability that we'd expect to sustain the growth that we're expecting in this country in the renewable asset class broadly over the next 30 years. So if I'm going to bring it back, the certainty of the IRA is going to allow market participants to plan the economics of projects with a much higher degree of certainty. This is going to increase the addressable market and therefore growth. That's all I had prepared in my remarks today, but I'm happy to take questions on anything the audience has is piquing their interest.
Thank you. Thank you, Buck. We're going to turn to a question that came in from several people, and it speaks to some of what you just addressed as far as party risk, the risk of political party changes. So the questions basically are, is there a risk of the Inflation Reduction Act measures being rolled back by another political party or leader? And I just wanted to chime in with a couple remarks there and then turn over to Jonathan to finish up. But just to give people context, in 2024, 20 Democratic Senate seats and 10 Republican Senate seats are up for re-election, with 4 seats that could change parties. So there is a chance that that chamber could turn Republican, as well as the election Republican president. However, as Buck just indicated, a lot of the benefits are going to Republican-led states, manufacturing expansions and job growth, and thus are very popular with the Republican base. So just as one example, the state of Indiana received $182 million for home retrofits and high energy efficiency appliances. And there are many more states that are receiving funds like that directly. And by 2024, the money and jobs will have started out the door, making pullbacks much less likely. So if a new president tries to rescind, they will likely be heavily lobbied directly by Republican governors. Getting the funding out of the door is the utmost importance, so that money is already starting to go out. And what may happen instead is intense oversight, but not pullback. In addition, that money's already been allocated, so there's no new funds necessary to ask from any new Congress. So I'll turn it over to Jonathan to sort of finish up that question.
Lolita, thanks for the answer. I think the other sort of reality is that there have been, and there probably will be, continued attempts to pull back spending in the US in general. And we've already seen some of those attempts having been aimed directly at the Inflation Reduction Act. None of them so far have been successful. There was a piece of legislation that was passed the other day, but it doesn't necessarily pull back spending specifically associated with the tax credits and other greenhouse gas emission reduction objectives for the Inflation Reduction Act. But just as examples, there have been a number of bills put forward, or even acts proposed, usually like the European Research Group was a few years ago, directly trying to address or sort of counter what they sound like they're about. So energy independence and emission reductions was one proposal that got put up and wasn't passed by the House of Representatives. That was aimed at removing some of the tax credits. Lower costs, more choices, more jobs was one of the headlines put forward, but wasn't passed by the Senate. There are one or two lawsuits which are outstanding from Republican lawmakers, specifically going after some of the tax provisions, but none have been successful. There was, for completeness though, a measure passed in the House which specifically aims at pulling back some of the measures that the Environmental Protection Agency can deliver. But again, they were not specifically aimed at, or indeed success, even if they had been, had no impact so far on any of the tax credits or other market incentives specifically rolled out by the Inflation Reduction Act. So, so far, I think it's a great question that a huge program like this could face objections and even attempts to roll it back. So far, it has survived, and I think Lolita has explained some of the reasons that is the case, which seem to be enduring reasons, which there are a number of Republican states which are standing on the front line to benefit from this. So that, I think, concludes my comments on that question.
And did any other questions come in? Yes.
I'm sorry, Lily. So there is another important point, which is that going back to what we said before, I mean, we have been investing in the United States on-site generation energy efficiency market because of the cost competitiveness of the technologies that we typically support, because of the energy security benefits that our projects introduce. So while the Inflation Reduction Act is a great tailwind for what we're doing, we have been in place already prior to the Inflation Reduction Act because of the basic commercial economic merits of what we're doing.
Have any other questions come in?
Lolita, I think there was a question from much earlier, which is a much more general question aimed at SEEIT. And I think that acknowledges that SEEIT today is trading at a discount, and the various different actions that SEEIT might take to to address that. I think if you don't mind, Lolita, perhaps just sort of addressing that quickly here. I think we obviously are hugely sensitive to the discount to NAV. I think one of the big ways that we can address that, which we're consistently looking to improve, is the level of communication that we have with shareholders, the way that we illustrate some of the characteristics of our underlying portfolio, and how we've constructed it and the value that that can deliver to shareholders going forward, helping to improve the attraction of that portfolio by making it perform better, but also by communicating that to existing and new shareholders and trying to bring new shareholders into the company, improving marketability and liquidity. We've also been taking action to look at returning capital to shareholders. We've done that through some buybacks earlier on in the year. The board demonstrated its commitment to acting and did so with huge support from us as a manager. I think the board has intimated previously, as we have, that course of action remains available to the company if it's deemed in the best interest of shareholders. Some bigger factors that we can and are looking at, and we've been clear about that as well, is also generating additional cash flows from our underlying portfolio, looking at ways in which we can enhance liquidity within the business, making sure that we keep leverage at moderate levels going forward, and potentially to look at ways in which we can continue to provide liquidity, not just through dividend, but other returns of capital to investors. So I think clearly the discount to NAV is absolutely top of our mind. I don't think it's any one individual action that's going to eliminate that discount, but it's a multiple series of actions that we can take at portfolio level on performance and at company level on marketability and liquidity of our shares. And I think the engagement with shareholders, including but not limited to events like this, is an integral part of that. So many thanks to shareholders today for joining and listening to this webinar.
So we don't have any other questions that have come in. So Jonathan, if you'd like to close out the webinar for everyone, that'd be wonderful.
Well, thank you very much indeed for everybody for joining. I think we are up to or just over our time. Please get in contact with us or any other means to continue today's discussion. We're obviously very excited about some of the impacts that the Inflation Reduction Act can have on our portfolio. Europe has a similar scale initiative underway with its policy of energy efficiency first, translating into different types of market incentives available in Europe. The UK does not have a comparable program today, but again, as you know, we're well invested in the UK in projects that are delivering lower cost, lower carbon, more reliable energy solutions. But we're very grateful for everybody's time today. Thank you for listening to us, and thank you for being invested with us. And I think probably you'll get the sense that as our largest geographic exposure is in the United States, we're very happy about that. And there are some really important growth opportunities for us in that market that we'll look to fully exploit. Thank you.
Thank you everyone for joining us, and have a great day.